The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing, Guy?
I'm enjoying this wonderful Texas weather, 87 degrees one day. Woke up Thursday morning, looked at our little weather station, 34 degrees. Woo!
My whole neighborhood is basically transplants.
Right.
And they're loving it. They're all from, the Midwest, Chicago,
Getting
New
snowstorms
York.
this week, yeah.
They're like, wow. And so they like it. It's weird. Like I said, the only one I've known going the other direction is my son. Went from Texas to New York.
He did, right?
Yeah. Most of them come down here.
Does he like the weather up there?
He likes everything about it.
That's good.
He doesn't like it. You have to be in a big city. Has to be all the. I can't stand it.
Don't need a car.
I walked through his neighborhood and I got bumped into about 500 times.
You keep reaching for your wallet afterwards and make sure it's still there.
I can't take it. He goes,
don't call if you're from New York. It was just a joke.
He said, isn't this subway great? I go, no, it's not. I want to drive my own car. All right, well, this week we're going to talk about, there's different things. Larry Kotlikoff, Lawrence Kotlikoff.
His friends call him
economist. Yeah. In Dallas. He's taking over for Scott Burns in the Dallas Morning News. And he's starting to put some articles out that are I like a lot of what Scott Burns does, but there is some of it that's antiquated at best. Some of the information.
Fake news, maybe?
So this week in the news, U.S. housing starts were down 2.6 in January, 2.6%. Geographically, the West was down 41%, the Midwest down 18%. The Northeast, though, which is actually the smallest area of new construction, was up 55%, and the South was up 20%.
I saw a deal. It was almost contradictory. It's the starts were down, but new home loans were up. I'm like, okay.
That's what I said. Right now, most of that is the housing starts going down. Honestly, we're multifamily.
Right.
They were lost 8%. Single-family homes went up 2%. And single-family homes and housing is a better indicator on how strong the economy is. Right now, they're at a 10-year high. And so the market's peaking, right? We've had recent interest rates rise over the last, couple months. And it's weird. Rising interest rates should make housing go down, right? Because it costs more. People buy a payment more than they do the price.
Absolutely.
Right? But in reality, the first few months, maybe even a year of rising, they're locking in rates because they're afraid.
They're rushing to get that rate before it goes any higher. You bet.
Right. So that's what happens. So eventually it'll go up, spurring on activity, but there'll be a tipping point, and if it goes in a lot higher, it'll crash.
Well, Yellen talked earlier in the week. In December, we got a 0.25% hike. Things start to come in line with that now. They're starting to come up. And she talked about trying to get 3 rate hikes in through 2017. They're already walking that back, talking about 1 or 2. So the economy's been up, 10, 15% since the election. So you would think.
The market has, yeah.
That's what I mean, the market. You would think that it could shoulder an increase. I don't know.
I think a lot of it's done with smoke and mirrors.
Well,
when you look at the valuations we've got now, I'm like,
do tell, explain that.
All right. That means we can get more out of it. Okay. I mean, you've got right now, with the PE ratio where it is, like I said, all corporate earnings of the market would have to increase like 30-40% to equal the valuation they have now. I don't think that's happening.
I'm glad you went there. There's several different camps in investing and trading and all of that. Fundamentals, which is what Victor is talking about, I certainly subscribe to, whether it's real estate or the market. Then you've got the technical traders, and based on formations, and we've talked about that, it kind of dictates and becomes a self-fulfilling prophecy as far as how they invest. But in my opinion, nothing beats fundamentals. When you're overbuilt, right, like we were for a long time, whether it's leasing space, if you're getting an office, or whether it's a home, then things are relatively cheap. And of course, rates dictate that to an extent. And when you're underbuilt and the supply isn't there to meet the demand, prices go up. And that's what you're talking about in the market right now. Right now, the market is overpriced. It happened big time. We all remember 2000. I'm not overlooking '08, but in 2000 in the tax, remember Amazon 500 to 1 and the PEs were crazy, but everyone was rushing. No one wanted to be out of this big bonanza. And what happens when the very last person that has never been in the market gets in the market and closes the door behind them?
It crashes.
It crashes. So just be careful. There's a lot of things out there.
Everybody always tells me what's different this time when they're talking about the market, no matter what market it is, if it's real estate, the stock market, it's never different. It might be a different time, a different calendar. Yeah, I get that. But what happens is it's supply and demand is capitalism. When you have a shortage of something, prices will go up and the demand will go up. Therefore, they'll start building more of it.
People will stand in line for something and they think they can't get it.
They quit building apartments, virtually quit building apartments for like 20-something years in Dallas. Now you're seeing them going up everywhere. And what they will do, just like they will do with houses, they will overbuild like they always do and always will. And then prices will come down. That's just the nature of it.
Yeah. And
same thing with the stock market.
And I love my wife, and she's very dear to me, but she doesn't do stocks. And the reason I'm prefacing this, I'm going to use her for an example. She doesn't do stocks and doesn't pay attention to that all day. Obviously, that's my job. I do it, and we try to work on things together. But everyone's getting into the market. It's going up. We recently went to cash about a week or so ago, and she never talks about the market. She came up, are we in the market? Get me in the market. Make sure my 403 is in the market. She never talks about it. A real big light bulb went off in my head. So, maybe it's pretty smart to be on the sideline for now.
Right. That's what happens. That's what Kotlikoff's
we're missing it. You got to get
article is talking about, too. But just more on the news. The initial jobless claims rose 5,000 to about 239,000, which is still historically low. New claims have been below 300,000 for 102 straight weeks.
And we're going strictly on claims, right?
That's right. Now, I know they adjust the unemployment where as long as the person's not on unemployment anymore, they don't count.
He's employed.
He goes to employed.
That's right.
So, or if you're underemployed, like so many people now can only work part-time, they can't get a full-time job, but they're employed.
Yeah.
So I get all that. Another interesting thing, for the first time in 46 years, mortgage rates aren't moving with the 10-year treasuries. Now, somebody might say, well, they don't move with the 10-year treasuries anyway. No, they actually move with the 30-year treasuries, right? But they still move with the 10s as well. In other words, the 10-year treasury goes up, mortgage rates go up. 10-year treasuries go down, mortgage rates go down. But this year, the 30-year bond dropped 17 basis points, but the 10-year stayed the same. All right? And 30-year mortgages went down 0.02. So, yeah, it's a weird thing. It's 46 years since I even tracked each other almost exact. But this year seems different. Last year kind of seemed different kind of election than I've ever seen. This year's kind of a different kind of presidency. Who knows what's going to end up? I hope it ends up great. Who knows? But everything's different.
With the promised jobs and the little bit of movement that we've got, I would like to see this thing just take off like a scalded ape and run for another 5 years. And, the market, it could do that. It's never done it before, but it could. But I wouldn't bet the farm on it. There's a lot of things that make me, I'd like to see that happen. But I could make a better case that it won't.
I've got a question. What does a scalded ape look like?
No, run like a scalded ape. If you scald anything, by George, they're going to run. What do you mean?
I think I'm losing my voice.
You are losing your voice.
I have it all day, and then when I'm doing the radio show, there it goes. Remember, folks, if you have any financial questions, if you'd like to take advantage of our no-cost, no-obligation retirement analyzer, stress test, and Social Security optimizer, don't hesitate to call us, our hotline. If you just have a financial question, how to allocate a 401k, whatever, don't hesitate to call us. 972-715-2424. Again, 972-715-2424. You can always go to ilovemyretirement.com. There's what was the section? One of the sections on my website is updated almost every week, which has different white papers and things that might be of interest to you.
Good information.
Also, you got all of our radio shows. I know some people got suicidal because they might have missed a show or two, so you can go back and listen to them. I still remember the guys when we did some streaming ads. You know, we've been doing ads in Dallas for 20-something years, but we did some streaming ads on some of the sports stations here recently.
We were supposed to get like two or
About two
three
a day.
spots a day.
They would run the same exact spot back to back like 10 times in a row. I had a really good friend of mine. I haven't talked to him since I was a kid. And he goes, "Oh, my gosh, I heard your commercials." He goes, "But I had to turn the channel." I go, "Why do you turn the channel?" He goes, "They're playing your commercial like 100 times an hour."
Oh, I know.
So having exposure is good. Too much exposure, not so good.
Amen.
All right, well, we got a break coming up, folks. Remember, if you have any financial questions, don't hesitate to call us at 972-715-2424. Our website is ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome to the show. Remember, if you have any financial questions, don't hesitate to call us at 972-715-2424. If you heard my commercials for decades now on how to get 6 or 7% guaranteed, again, 972-715-2424. If you would like to take advantage of any of our complimentary programs like our Retirement Analyzers, Retirement Stress Test, Social Security Optimizer, again, 972-715-2424, or you can always go to ilovemyretirement.com. All right, let's talk about the person that's taken over. You know, the owner of the Dillon Gage Metals Companies, Steve Miller, has known Mr. Kotlikoff for a long time, I believe. Larry, that's right. Only to his friends. He's taken over for Scott Burns. He's actually an economist. So, Guy doesn't like Scott Burns.
I didn't say it. I like Larry.
But he was talking about, it's funny, you know, you've heard that old saying, if you get 10 economists in a room, you're going to get 10 different opinions.
You're going to get 12 different opinions. No, I've heard that. That's right.
It is weird, though. You talk to one economist, he'll talk about, let's say, the Obama era, right?
Right.
Oh, my gosh, the greatest growth, best. Then you're going to talk to another one that says, oh, my gosh, it's the most stagnant growth. It's fake, blah, blah. And it's the exact same numbers.
Well, think about it. Obama hired who he thought was the very best economist to come up with his plan, right? Trump hires the very best that he thinks to come up with his plan, and they're both completely 180 degrees different.
Right.
So they're two smart people.
And the title of the article is What You Don't Know Yet Might Hurt You. Also, he's telling why he thinks everybody should get out of the market, or he's getting out. I don't have an opinion. Whether the market goes up or down, I'm ready for either one. And so if you design your portfolio correctly, it will not matter what the market's going to do.
Yeah, and sorry for interrupting, but take the fear out. Be able to sleep at night. You know, we've done many radio shows on taking the emotion out and how emotion affects how you trade on the market. And it really affects you adversely. And if you can do things and prepare for that so that's not even part of it. Again, our philosophy, take care of your hard expenses first. If you know you need $5,000, $10,000, $15,000 a month, whatever your number is in retirement, not the penthouse, not beans and bologna, right? But a comfortable retirement. You know that's taken care of. It's absolute. There's not much stress other than normal things in life. So we try to remove that.
And I don't care who you are. If you think you can take the emotion out of investing when you're 100% stocks, you're crazy. We've been in this business a long time. And trust me, if my retirement savings dropped in half overnight, I'd be pissed, number one.
Oh.
Scared, number two.
Yep.
And holy crap, do I got to work till I'm 90 now?
And people prey on those emotions. You know, the biggest emotion that people have, the biggest fear, is running out of money in your retirement. Don't want your kids to take care of you. Don't want to have to be on Medicaid. Handle that while you can.
Think about the emotion. That's what the first part of his article is talking about. It says economic theory is not perfect. Investors often adopt the herd mentality. Prices are rising like crazy. Everyone's buying.
What's going on now?
Right. They must be know something I don't know. I don't want to miss out. That fear of missing out is a big one.
That's why my first segment we talked about my wife. Market's going up. Everyone's, Guy, are we in? Are we in? Are we getting part of this? You know?
Well, no. So you got to be, but if you're planned properly, it doesn't matter what the market's doing in the short run.
And you're not moving in and out and trying to keep up and messing things up.
See, it's saying right now we're in a point of irrational exuberance, which produces asset bubbles leading to crazy valuations. Remember, the market is overvalued. Then it talks a little about tulip mania. That was funny.
1860s or
1630.
Oh, okay. Well,
They
close.
had
Not.
Well, a tulip, one bulb costs as much as a house. It's like, wow.
Until what? The plague came out or
That's
something,
right.
and they didn't want to stand in line to buy them anymore.
That's right. That's exactly right.
Right?
You got to stand in line. No, I might get the plague.
That's right.
But we're talking about Kotlikov's last article in Dallas Morning News. Today's price-earnings ratio is higher than in almost every year since 1880.
Read that again.
It says today's price-earnings ratio, that's your price of your stock, how much earnings you have, right, is higher than it's been in almost every year since 1880. So it's not saying it's the highest ever.
No,
but
because 2000.
Almost every single, there might be 2 or 3 years was valued higher, and 100 years. And so that's something you got to think about.
It's not an absolute, but you got to think about it.
Here's where he says and don't call me, please. I'm not political. I'm just reading an article.
You're not a friend of the administration. I'll just say that.
I'm a friend of everything. I voted for this administration. I'm a friend. But it says you have what about a trade war? He talks about the expulsion of the U.S. from the World Trade Organization, international boycott of American goods.
Fake news.
Or an international boycott of travel to the U.S.
Fake news.
It says 40 million U.S. jobs, 1 in 5, depend on foreign trade. And any of them could burst the stock bubble. Even a little bit of this stuff, when you're overvalued this high, anything can trigger the market. But that's the first thing he's talking about is somehow them boycotting our exports.
Well, and you saw this. We talked about it last week. If you listen to the show a little bit, right now, what are the 2 big things? Reform and appeal Obamacare and tax tax cuts. All Trump has to do nowadays is mention that it's on the plate. We're going to talk about it in March, which he just recently did, and the market ran forward again. He doesn't mention it for a few weeks. This is how sensitive things are right now. Think about it. He doesn't mention it for a few weeks, and the market starts going down. When it moves that quickly on this slight information, you have to be careful.
Oh, I know. They're talking about, the TPP is gone. Now the next is the NAFTA, all of those kind of things. And those could cause, if we do tariffs, that could cause prices to go up. There's several things he's talking about here, but all of them sound logical that maybe one would happen. We got a break coming up. Stay with us, folks. We'll finish this when we return from the break. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. We're talking, before the break, we're talking about Lawrence Kotlikov, the economist here, filling in now for Scott Burns. And what they think why he says, I think you should sell all your stocks. This is just one opinion of one economist, obviously. But it's interesting. They're just saying that when you're overvalued this much, which he states one of the highest valuations since the 1880s, that anything could happen. In other words, like I said, if you tariff, then they quit buying these goods or whatever. It hurts our exports. They'll take it. Whatever the case is, it doesn't take a lot to tip it over when you're on the top.
Well, and let's expound on that, I guess, a little bit. Right now, the Trump administration is under a magnifying glass. Any slight thing that they do, even if it's good, in my opinion, gets spun and made to look bad by most of the media. So all it takes is one mistake, or what they perceive as one mistake, and then the media to pounce on it, and the market very well could go down 10, 20, or 30%. Do you want that to happen with your retirement?
Yeah, you got to. I get, but we talked about this before. It's not fair that we don't tax goods coming in, but they tax them going into their countries, all that kind of stuff.
Right.
But
value-added
they've
tax,
had that long, that way, right? That all of a sudden we start taxing them. They could ban our exports or boycott our exports overseas, even if it was just a threat of it. with the market topping out, it could cause it to correct.
You know, the problem with all of this stuff, we sit and we discuss it. It's not that easy. If we add let's say a 20% tax, they've got a tax on theirs coming in. It's supposed to level the playing field, right? But it doesn't work that way all the time. Now, all of a sudden, our citizens are paying a tax to compensate for the tax cut that they just got. So, I mean, which way is right? It's not that simple, is it?
No. Well, here Ed's just say, it says, my recommendation, Mr. Kotlikoff.
Here we go.
Sell your stocks and long-term bonds too until the dust settles. If your stocks and long bonds are in retirement accounts, transfer them to short-term treasuries. No one knows where all this will lead. But we do know that uncertainty and the stock market don't mix.
And we have uncertainty. We've had a really good run up lately. Most of you have probably made 15%, give or take, unless you're paying really high. And if you haven't made 15% and you were in the stock market for the last 60 days, certainly call us. Let us take a look, see what the fees are, see what you're paying, because you should have at least enjoyed this run up some.
See, it's weird. A lot of people say they're waiting for the news, like we do get a tax cuts, right?
Right.
That's what the market is valuing itself based on tax cuts.
And the tax cuts already figured in, right? If you don't get it, you're screwed.
If you don't get it, it really crashes, right? But even if you get it, it might crash because the price was already baked into the market.
Right.
So that's where the market is always forward looking. It's always forward looking. So when you find out, that's what they used to say, buy on rumor, sell on fact.
That's right.
So as soon as the fact comes in, sell it. But it's interesting. That's not the only economist doing that. I've read others that think it's going to go up forever.
Yeah.
I'm a numbers guy. I just know market's gone up 8 years in a row. That has happened one other time in our history. It has never made a 9. There's a reason for that because things have to correct themselves so the valuations don't get crazy. And so either the earnings of these companies have to skyrocket or the price has to come down to meet current earnings. Otherwise, you're going to stay overvalued. A correction is healthy for the market. It needs it every once in a while. Just have your plan in place, and it won't matter as much to you.
You know, one of the other articles we were reading, getting ready for the show, and I forget who it was. Maybe you can fill it in for me, Victor. But they were talking about giving some financial advisors giving their clients advice as to not contribute to their retirement accounts right now because, if you contribute, it goes into the market, you're going to lose 20 or 30%. Wait for this to come down and then contribute double. Well, the answer is you never stop contributing.
Nope.
You can go to cash in those accounts, but now you're trying to trade the market. If you're young enough, obviously you stay the course and you'll be fine. If you're like Victor and I and you're getting older, then you have to be a little bit more judicious. But don't stop contributing.
Remember, if you've listened to this show for the years, that is one of the first things you know if you're talking to a crook or somebody that's not an advisor or a terrible advisor. When they tell you don't invest in your 401k because you need to put it with me, this is way better than your 401k. As soon as I hear something like that, it makes you cringe because we need to get those crooks out of this business. You cannot tell me if you got a match, well, they only match you 3%. That's free money.
100%.
It's tax deductible free money. If an advisor's telling you not to max it out, they're suspect. Okay? If they tell you not to, they're either a crook or an idiot. And I'll tell any one of them to their face if they want to call me because you cannot tell people not to take free money, tax deductible money. Was that one person on the radio? I think it's on this station saying, no, 401ks, IRAs, they're not really your money anyway.
Yeah.
Just cash them out, take the hit,
Yep.
lose half of it in taxes,
Yep.
put it with me, and we'll get all that money back in a couple
People with
years.
real money do this.
Yeah.
Yeah.
Whenever they say crap like that, just run from the radio or run, whatever. The real people, only wealthy people do this. Shut up.
What they're talking about is a life insurance program, and if you're young enough,
And a real estate program too.
and you can contribute 20 or 30,000 a year at a young age, which is difficult because you still want to max out your 401k, then those things will provide tax-free income for you, possibly.
We got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. All right. If you don't have a formal written retirement plan, you need to call us. Now, your broker telling you you're going to be fine is not a formal written plan. somebody giving you a Monte Carlo simulation that says you percentage-wise you'll be fine as long as this and that happens.
The probability
Not a
is,
plan.
Yeah.
If your plan the market has to make 8% a year, 6% a year, 5% a year, or anything, that's not a plan. That's a hope that the market keeps going up. If your plan doesn't work, if one of you or your spouse passes away, that is not a retirement plan. You need a plan that takes care of you both if you're married, right? If something happens to one of you, it takes care of the other one. Even though I have seen over the 30 years many people saying they didn't care what their wife got, she'll be fine. She won't have to feed me anymore. I'm like, oh, Lord.
The hardest ones for those of you out there that have a spouse that's 20 years younger than you, because whenever you plan for income, it goes by the younger's age. It's very difficult, but you still have to stay the course.
Right. Your plan must, like I said, it can't rely on the market going up or down. It can't rely on interest rates going up. It can't rely on both of you staying alive to your 100. And it can't rely on you of the market making 8% forever. I just saw another one this week. Said, no, Victor, you don't understand. My advisor said I'll be perfectly fine. We've averaged 8% a year on this thing, and I only got to make 6. And I was like, holy crap.
Do we want to even start with the flaws? If you're averaging 8%, the compounded is probably 5.5 or 6.
Less. Yeah, it just doesn't work. When you're taking out money, it does not work. It's impossible. I had that same person. They said it was going to be fine. We're completely running out of money in the first 10 years of retirement. The market had to make at least 6 to 8. I can't remember the number, but 6 or 8%, which is really hard, especially after it went up 8 years in a row. If you've ever looked at a market, when it goes up for a long time, the preceding 5 to 10 years is terrible usually. It's because you're going to have to account for a correction in there, all kinds of stuff.
Yep.
So those are not plans. Call us. We'll devise a real plan for you. It's 972-715-2424, 972-715-2424. You can always go to our website, ilovemyretirement.com. Now, our philosophy is different than other advisors. We've been doing this, Guy and I both been doing this 30 years apiece. But we believe that you should have a guaranteed income stream, whether that's a pension, a Social Security, an annuity, whatever you need to pay the amount of bills you have. And then the stock market is a great tool afterward to help cover inflation, your liquidity needs, all of that kind of stuff.
There's 2 types of plans, Victor.
Mm-hmm.
You have a guaranteed plan where you have absolutes, and what's the other one?
A non-guaranteed plan.
That's right.
That you're hoping the market goes up, right?
That's right.
And we've been managing money in the market forever. I'm in the stock market. I like the stock market, but I don't take the money, my mortgage payment, and go put that on red in Las Vegas. The stock market was never designed to pay your bills. It is designed once the bills are paid and you would like to speculate some to get you more potential growth. There's nothing wrong with that. But think about it. Would you ever put your mortgage payment on red in Vegas, but yet people do it all the time?
No, and before they came out with these fixed annuities and these income guarantees roughly in 95, Victor and I did manage money. And you have to believe us, before we hitched our wagon to anyone, we did our research. We knew how to research. We were in the business to that previously for 15 years, give or take. And we found the very best managers. That's all they did. They didn't do any marketing. They didn't do client service. All they did all day was manage. Top guys in the country. One guy had a degree, honors degree in banking and finance from North Texas. Very sharp fella here in town. And they do great until the market shows them something different. And the market always shows you something different. So all we're saying is not to be out of the market, but the money that you've got in the market is your non-guaranteed part. You can do real well, but just know that's your non-guaranteed part of your retirement. We can do that for you and would love to help you. Think we do a very good job at that. But before we address that, we want to talk to you about your guaranteed part of your retirement.
Remember, don't hesitate to call us at 972-715-2424. I'm going to finish this study real quick that we started last week. It was from the American College in Bryn Mawr, Pennsylvania, and it was consumer attitudes towards retirement.
If you don't hurry, we're going to carry it on to the next show next week.
I'll try to go through it quick.
All right, here we go.
It said these are the top 10 takeaways of the study. Those who lacked a monthly retirement income plan were 5 times more likely to feel unprepared for retirement. What did we tell you we do first? You get a retirement income plan
The
first.
guaranteed part.
Number 2, respondents without a financial advisor were twice as likely to lack confidence in their retirement preparedness compared to respondents with an advisor. That kind of makes sense, even though I know a lot of do-it-yourselfers that have more confidence than they really deserve, but they have it. All right. Number 3, the consumers who felt most confident about retirement had written comprehensive plans in place that annuitized a portion of their wealth and dealt with long-term care and estate planning.
Peace of mind.
A more comprehensive approach. Remember we said you got to have a plan that does all these things. One of you can't pass away and the plan doesn't work. Stock market goes down, the plan doesn't work. Those aren't plans.
You don't make 8%, plan doesn't work.
That's right. You got to have something, and that could be 6%. Whatever the number is, that's
Right.
not a plan. That's a hope. You got to have this. You got to have a comprehensive written plan. Somebody telling you you're fine is not a written retirement plan. I say, I'm fine. Why don't you guarantee that in writing? And you'll see them squirm, right?
Yep.
The next, number 4, respondents who are more confident about managing their own investments throughout retirement were also more likely to see the benefits of having a guaranteed monthly income stream in retirement. Now, that's interesting. These people manage their own money, yet they find the value in getting a monthly income stream. Top the opposite of what you think. We got a break coming up, folks. We'll finish this study when we get back. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. And I apologize, my voice is going. I had my 3 nephews with me a couple days ago, and they had a lot of snivels, and my old body can't take it.
Well, thanks for sharing that with the rest of us. I won't be coming in
Anybody
Monday.
that knows me I always come to work regardless, and if I'm sick, people don't like it when I'm at work. Oh, why are you going to give it all to us? I'm like, well, stay away from me then. All right. We're talking about the retirement study that is consumer attitudes towards retirement from the American College up in Bryn Mawr, Pennsylvania. And here's number 5. Respondents who are not confident about managing their own investments in retirement were 4 times more likely to view having a guaranteed monthly income source in retirement unimportant. Okay?
Now,
so if they're not confident in managing their money, they don't think it's important at all to have an income.
Well, think about that. Think about the one before that. People that like to manage their own and don't like to give control saw the value.
That's right. People that are very good at managing their money saw value. That's what I said. Compared to those who had moderate to extreme confidence in managing investments. So wait a minute. That doesn't make sense, does it?
Well,
somebody that was really good at managing their own money sees a real value in getting a monthly income stream, but 4 times more than a person that's not very good at managing their money.
That's right.
Very interesting.
Part of that herd mentality, I'm thinking.
Number 6, respondents without an annuitization plan. Annuitization plan is just, let's say I've got $2 million, taking $500,000, guaranteeing an income stream with it, letting the rest float in the market. Since it pays so much more income per dollar, I should die with more than $2 million, theoretically.
We talk
about
it
just makes anything at all
the time. This income stream enhances the return of the rest of your portfolio
because you don't have to sell when the market's down. You can allocate,
and you're not drawing on it.
That's right. Number 7, respondents without an estate plan in place were twice as likely to be dissatisfied with their financial advisor. That's why, well, I don't want to say that's a good bad thing because that's why we've got clients for the last years.
That's why when they come in here and they sit down,
wow,
my advisor didn't do this for me.
That's what I get. I got it twice this week.
Yep.
They go, the other advisor gave me one product and just said, this is good for you. You went through a whole process of saying, all right, what about rising healthcare costs? How's that going to affect you? What about your Social Security?
But they taught a class and they gave me 30 minutes of time.
That's right. What about this? What about that? What about even when you determined that maybe that product might be suitable for me, you looked at 200 of them.
Yep.
Not just one, trying to sell you a product. You also said, okay, with the remainder of your funds, this might be a good strategy. The other person was just trying to make an annuity sale or a life insurance sale and didn't care beyond that.
But make no mistake, when you come in and we start hearing where you are and what you need, we're formulating. We've got some ideas where you're probably going to end up, but we don't make that decision unilaterally. We go through the process and let everything point us, and then research, see if there's any changes. Things are changing all the time.
You want math by your side, not some yahoo's opinion. Because that yahoo, which could be your broker, could be wrong. And the one thing I don't want, let's say I'm going through retirement, this advisor's been great the whole time, and I'm 75 years old, and all of a sudden the advisor goes cuckoo or something, or didn't predict, and the market crashes, I lose all my money. You can't have a broker wreck your retirement either. You can't have your death, or the stock market not going up, or interest rates not going up, or your broker gone crazy affect your retirement.
Let me throw this in there. What if your broker dies? How's your plan then?
And it could be his idiot son, or maybe he's got a Harvard idiot son. I don't know. Either way, you can't rely on that stuff. Your plan must stand on its own, or you do not have a plan.
That's right.
Our number's 972-715-2424, or go to ilovemyretirement.com. All right, we're in number 8 out of 10 of the American Colleges
We're going to make it.
Study. It says the cost associated with health care and the risk of changes in Social Security were the top 2 retirement concerns for consumers. So if your broker has not talked to you extensively about those things, are you really getting what you deserve as a client? Now, you're going to pay the same rate almost everywhere, but you're getting half of the goods. That's why call us. We'll get you a real retirement plan that stands on its own, not relying on the market, interest rates, me, or anybody else.
That's right.
972-715-2424. Okay, number 9. Honesty and knowledge were the top 2 desired traits of a financial advisor. Was that in opposed to dishonesty and lack of knowledge?
And no knowledge.
Well, I would figure.
Oh, it makes sense.
I'm telling you, I've been doing this 30 years, and when my dad was in it as well, and I tell you what, this thing has changed. It used to be just sales. It's a handshake, a wink, wink, and just take the guy to a country club, whatever. It was a sales deal. Now you better be packing the gear, because people are more educated than they've ever been, and they expect more, and they should expect more. All right, number 10, the last one.
Here we go.
Respondents with a written monthly retirement income plan developed with their advisor that annuitized some of their wealth were more satisfied with their advisor, more likely to recommend that advisor, and they're more likely to believe they have adequate value that they have paid for.
Does that sound familiar to anyone out there listening?
That sounds exactly what we were talking about. You have to have a written plan. You can't just go in and say, I think I want an index annuity. Well, maybe an annuity is the worst thing for you.
Yep.
I can't say that I only want stocks. I mean, 100% stocks. I got saving late in life, so I need to take more risk. Those are the people that need to take less risk. You should only take risk if you can afford to take risk.
And how much should I put in stocks? All of it?
That's right. I have it all the time. There's some gut feeling. You got to get the standard financial planning, retirement planning rules in place. Put a reasonable inflation rate. Well, that's our show today, folks. Thank you so much for listening. Don't hesitate to call our hotline at 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure for Guy Allert. We always, always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice